Good afternoon, everyone. Once again, my name is Balaram. I'm a chartered accountant from India, and I was in Dubai. I worked with big four firms like PwC and Deloitte in audit. I also worked with industry in oil and gas. I started from auditing and spectrum accounting in UAE. It is about 80 years old company, a firm. We do provide audit, accounting, consultation, taxation, value-added tax, compliances like economic substance regulation and anti-money laundering law. So today the session is going to be more about retail and trading related activities, businesses. We will be trying to cover more on corporate tax related to these activities as well as value-added tax related provisions as well as economic substance regulation. So these are the three laws that have some areas which are common. So we wanted to cover those common areas to the extent possible, and I'm sure it is not difficult. It is difficult to cover everything in this given one and a half hour time, but we'll try our best to focus on key areas so that we know or we understand what is the difference and what are the similarities that we have among these laws with respect to retail and trading. When I say trading, trading also includes distribution activities. So one important thing to note here is that we are only expressing our own views based on our experience as well as by reference that we made to the law as well as other publications of the minister, ministerial publications or guidances. But at the same time, we also mentioned that these are to be considered as the opinions expressed by the individuals on a personal capacity. Any decision that you take, it is always advisable to go back to the law, and the right source is going to be from Ministry of Finance. Look at the law released by Ministry of Finance, and then based on the your understanding of that particular law, you have to take a decision. So we wanted to mention this clearly upfront. But at the same time, we try and attempt to add value to your understanding of the laws, of these laws, in fact, so that it becomes easy for you to understand it more better. So this is the intention of having this session. So without waiting further, I invite my colleague Manish Raf to take the session forward. Thank you. Over to you, Manish.
Thank you, Balram, for the introduction. I am a chartered accountant and I've been working for last 20 years, work with Big Four Consulting into audit and taxation services. So today, as Balram already mentioned, that we're going to cover about the corporate tax in UAE and how what impact it has in the retail and the trading sector. And then also with respect to the VAT and then the economic substance regulation, how does this has an impact, because there's some common similarities in between these. With that respect, we talk about the qualifying free zone, and then what are the criteria they meet to achieve that 0% qualifying income, and then within the group companies or the connected parties transactions. And then from the accounting perspective, what are the expenditure which are allowed or disallowed, and then how do you form a tax group. So there is a difference of tax grouping in the corporate tax and under the VAT law, which we'll talk about it, and then the impact of those under the VAT and the ESR. So considering the background in terms over the last 5 years, we have seen the compliance in the UAE has been increasing. It started with like country by country reporting, which is for the large multinational organization which has a presence globally, and the turnover is more than $3.15 billion dirham, where the reporting has to be done for each country. And then ESR, which is specific requirement to specific business activities, and under that, distribution and services is a part which is applicable to the trading activities where they have a distribution. So we'll talk about today that. And then the VAT, everyone is aware of it. It's a sales tax on the sales, on the VAT is a sales tax being paid, and then the excise and the manufacturing. Then anti-money laundering, which is specific to the business activities again for the financial and non-financials. Non-financials include their real estate and gems and jewelry business and several other businesses for which they need to comply with anti-money laundering. And then finally, we have this corporate tax. So the whole purpose of having this corporate tax in UAE has been because until now, UAE has been considered as a tax haven country in terms of, there has been no tax on the profit which the business would generate. But that is no longer a scenario, and the purpose is they want to encourage other geographical regions, to invest in UAE when it is being seen at par with other countries where they are paying tax. And if that the tax is also applicable to UAE, then there is a transparency in the way the business is being carried out, because the compliance and reporting become quite robust. So that brings in transparency. So the investors, the global investors, basically the International Monetary Fund organizations, so they invest in this country, and then that's how the growth of the country or the whole country is there. So looking at the legal structure, the geographical form in UAE, that we all know that it is divided into mainland and free zone, and there's another concept of offshore, which is similar for the corporate tax. It is similar to the free zone activities, and within the free zone we have around like 40 plus free zones, and where there are specific free zones like financial free zone and other free zones for trading activity, like DMCCs for the trading, and there are other free zones which are for specific business activities. So the taxation is, in corporate tax, the taxation differs in between mainland and the free zone, and within the free zone, if they meet qualifying free zone, which we will talk about it later. And in terms of the legal form, it could be in the form of, like, if you see on the left side, the blue colors, these are the natural person. These are like a sole proprietorship, civil company, partnership. Here, the business of the individual, the owner, is not different than what is the owner responsibility towards the business. Whereas on the right hand side, we see the red color. These are limited companies, public shareholding. So the entities, the business is different. The liability of the company is different than the individual. So those are judicial person, and on the left side, the blue color are the natural person. Those are the taxability requirement with respect to grouping or other compliances is different in these two categories. And as we all know that this corporate tax is implemented effective 1st June 2023, but it is applicable based on the financial period. So the financial period generally comprises of 12 months period, and which could be seen in the memorandum of association, which is part of your trade license. And say, for example, if a company has a financial period from July to June, so for them, the first tax period is 1st July 23 to 30th June 2024. And then the tax return filing period is 9 months after the end of the financial period. So the 9 month ends from June 30th, 24 is the March 25. So March 30, 25 is the 9 month ending between which we have to file the tax return. So whereas in the VAT we have quarterly returns, but in the corporate tax it's a one annual return to be filed. And as most of the companies in UAE would have a financial period from January to December, so for them, like, the first tax period would be 1st Jan 24 to 31st December 24. And then for them, the first tax filing period would be 9 months from December 24, which is 30th September 25. And now the corporate tax registration has been already started for LLCs and even for free zones entities. The registration are open, and then they can register. And the deadline for registration ideally is until you file your return, but it's always advisable to apply at the earliest, so that there could be certain queries or responses which FTA may ask for. So it's always advisable to register for corporate tax at the earliest. Now, considering the person and the tax base, for the taxability, it is categorized into two: general and the qualifying free zone, because the tax rate is different. So general generally covers your all mainland entities and even free zones, which are not falling under the qualifying criteria. So there is a slab that up to 375,000 of your income is 0%. So suppose if you have an income, the business income, net profit, income is your net profit. If it is like 500,000, then your taxability will be more than, if your earning is, so 500,000 minus 375,000, that is 125,000. So the tax will be paid on 125,000 of income, which is 9%. So up to 375,000 is a 0%. Now, when it comes to a qualifying free zone, on the qualifying income, they would pay 0% tax. But on the non-qualifying portion, they would pay tax of 9%, and there is no slab of 375,000 when they meet the criteria of qualifying free zone, but some portion of income is non-qualifying. Then they would straight away pay 9%, irrespective of the slab. They would not get the benefit of it. And if you see the whole horizon of the taxability is either it could be a resident person or a non-resident person. And within the resident person, it could be incorporated in UAE. It could be either in the mainland or a free zone entity. Uh, so it could be any LLCs within the Sharjah or Dubai mainland. They would be paying the tax, and even free zone also. If they meet a specific criteria of qualifying free zone, the tax rate would be different. But then still they are a taxable person. And then there's another concept of controlled and managed in UAE. So that means a company which has an operation outside UAE, and then the directors and the management is sitting out of UAE, taking a decision for the businesses. Maybe in Singapore they have some businesses investments. The income earned in Singapore would be also taxable in UAE, provided that it is controlled and managed in UAE. Then we have this natural person concept. There are certain business activities under which natural person will not be taxable. But if they are doing a commercial activities as like as any other license activity, then it would be taxable in UAE. And with respect to non-resident, it is categorized into three subcategory: having a permanent establishment. A non-resident, like an electronic trader based out of India, is supplying and selling in UAE, then and he has a branch in UAE. So the branch becomes a permanent establishment. Or if he has a dependent agent who is working for him and distributing across the customers in UAE, then that agent through which he's distributing becomes a permanent establishment. But there's another category like deriving source is UAE source income. So any income which is earned out of UAE, of course, becomes taxable. But he doesn't have any kind of setup or any kind of branch, but he's directly supplying to the customers and customers here, to the dealers or distributors here in India, in UAE. Then that also become taxable. But for that, non-resident will not be required to register, but there is a concept of withholding tax which would be applied. Currently it is 0%. So the income which he would be earning from UAE would get tax in the form of withholding tax, which basically would be deducted by the person who is basically purchasing this item. And then there is a concept of nexus in UAE. So the purpose of nexus is that any kind of source or any kind of relationship which is there with the income earned in UAE become taxable. And recently, the ministry has given a clarification with respect to this, that like for a non-resident who having properties in UAE, so the rental income earned by that non-resident legal judicial persons, which is having a legal entity status outside UAE and has a business in the form of rental income, that become taxable from that properties. Now, as we talk about natural person, so natural person under these three categories will not be taxable if he's earning a normal salary income or there's an annual bonus being earned by that natural person, it won't be taxable. And also his personal investment, generally people does a share trading into stock market, which is not a licensed activity. So that also is not taxable in the hands of the natural individual. And also the real estate investment. So resident who is basically who's having some units, some rental income from the different units in UAE, that rental income will not be taxable. Even the sale also or buying of that will not be taxable in the hands of individual. But other than these three categories, if he is running any kind of commercial activity, it could be like a freelancing activity, any kind of consulting activities which is a commercial in nature, will be taxable in the hands of individual. But there's a limit of, like, for registration purpose, if his annual turnover is exceeding more than 1 million for those commercial activity in the individual capacity, will be required to register in the corporate tax. And if it is less than 1 million, then it need not be required to register for corporate tax. So now we are going to talk about the qualifying free zone and the distribution trading activities, which my colleague Balram will take over this.
So, qualifying free zone person or qualifying free zones or free zones, they play a vital role in terms of the businesses in trading. So most of the companies from outside UAE come here to do trading by establishing their businesses in free zones. So that is why we just wanted to focus a little bit more on free zones from the point of view of corporate tax and other laws that we have mentioned earlier. So let's quickly look at what is the qualifying free zone person. So any entity which is incorporated in free zone, they can get a status called qualifying free zone person. Once a company becomes a qualifying free zone person, then they can get 0% tax benefit on their profits under corporate tax law. So it is important to look at the conditions to meet to get the status of qualifying free zone person. First and foremost condition is to maintain adequate substance in the state. So we look at this adequate substance condition in the following slide a little bit more detail. But it is more talking more about the employees being there, the asset being there, and the operating being spent in the free zone or in UAE to run your business, and not to have a shell company to run the business, but you have a real business that is happening in the free zone or in UAE is what is required out of this condition. Second condition is to have or to derive qualifying income. So free zone company should derive qualifying income. We'll look at this definition of qualifying income in the following slide. And also we'll look at the third point of satisfying de minimis requirement. So these two conditions together will be discussed in the following slides. And the next is not to elect to be subject to a corporate tax. So which means, so for a free zone company, though the company is in free zone, they can either go for qualifying free zone person status, or they can straight away elect to be considered as a mainland entity and be subject to the regular tax rates of 0% tax up to 375,000 dirham profit, 9% in excess of that. So to get the status of this qualifying free zone person, so a free zone company should not be going for this election. And then fifth point is to comply with the arm's length principles and transfer pricing requirements. So a free zone company, while doing any transactions with related parties or connected persons, they should make sure that those transactions are at arm's length, and any other requirements under transfer pricing should be complied with. And the last point, the last condition to meet is to maintain audited financial statements. So every free zone company should maintain their books of accounts and get their books of accounts audited to get this qualifying free zone person status. Any free zone company which do not satisfy any of these conditions mentioned above, so then they lose the status of this qualifying free zone person in that year. Plus, they also do not get this status for following 4 years. So in total, for 5 years, they will not get this status. Thereby, they will not be getting the 0% tax status of their profit, whereas they'll be subject to tax at the regular rates of 0% or 9% accordingly. And with respect to the maintaining adequate substance, either they can have employees on their own, or the free zone company can outsource those activities to a related party or a third party who is in another free zone or in the same free zone. However, the free zone company should have enough supervision on the activities of that particular team or company. There is one more condition mentioned that any free zone company which is part of a group which has 750 million euros revenue or more may be subject to tax at higher rates than 9%, which could be 15% under global minimum alternative tax. So it is not effective yet. It may come later, maybe in 2024, which is not just by it is going to be applicable only in UAE. It is going to be applicable across the globe for most of the countries, like 135 to 140 countries who are member firms of OECD. OECD means Organization for Economic Cooperation and Development. So under this OECD, they have mentioned various other requirements. So one of that is this global minimum alternative tax. So as I mentioned, so let us quickly look at what is the adequate substance. Here we try to talk about adequate substance requirement under corporate tax, as well as the same or similar conditions are mentioned under economic substance regulations also. ESR is applicable for most of the companies which are conducting the activities mentioned by the law. So even the objective of that particular law is also to make sure that the businesses in UAE have their real business being running, and they do not have, or the companies are not running, these shell companies are not having business but claiming to have business. So they don't want to have those kind of companies and businesses. In order to bring that into place, so they brought in this economic substance regulation. So just we wanted to compare what is there, the substance requirement as per corporate tax, and what is there as per economic substance regulation. So the conditions or requirements are more or less same in both the laws. In fact, Ministry of Finance has clearly mentioned that they're going to make modification or amendments to this economic substance regulation, and may also bring in some additional requirements for corporate tax for this particular adequate substance test, and make sure that both of them are in line or synchronized properly. So maybe once you comply with the adequate substance as per corporate tax, you may be assumed as being complying with the economic substance regulations requirement in terms of substance. But yeah, let's quickly look at what we have. Under corporate tax, they require us to have the core income generating activities to be conducted in a free zone. It could be in the same free zone where the company is established, or it could be in any other free zone. But it is also mentioned in some other places to have this activities being done in the state. So when they said state, it could be UAE. But I think it is not clearly used or used it properly. But in a few other guidances, they clearly mentioned that the activities should be conducted in a free zone. So a free zone company should have those activities being conducting in free zone itself. So the similar expectation is there even for economic substance regulation also. Corporate tax, we're talking specifically about free zone companies to get the status of qualifying free zone person, whereas economic substance regulation is for all the companies which are expected to comply with the economic substance regulation in UAE. When I said UAE, it is in free zone as well as mainland entities. So for those entities also, the conditions are more or less same, that they should conduct core income generating activities within the state, within UAE, either it could be in UAE, in the free zone or in mainland. So what is the adequate substance that we need to maintain in terms of what? Under corporate tax, they mentioned that they should maintain this substance in terms of assets, employees, and incurring operating expenses in the free zone. The similar expectations are mentioned or requirements are mentioned in economic substance regulations also. They mentioned the assets should be there, employees should be there, and expenditure or operating expenditure should be incurred in UAE to assume that you have enough substance. So just to give you what is substance. Substance means if you, let us say that your company is claiming a business of 100 million dirhams as the annual turnover. So if you say that your business is 100 million dirhams, so now we have to make sure that do you have enough number of employees in UAE to be able to conduct 100 million size of business. Do you have enough amount of asset base? Are you spending enough amount of operating expenses to the size of 100 million dirhams in UAE or not? So that's what they mean to say. So whatever business size you claim, whatever is the nature of your business, matching to those, do you have enough number of employees? Do you have enough amount of assets being there in UAE? And are you incurring enough amount of operating expenses in UAE? That's what they want to make sure that it is there. In the economic substance regulation, in addition to these, they also mentioned that the management of the company should also take place in UAE. They clearly mentioned that the board of directors should meet in UAE, and they should meet, conduct those business and those meetings physically in UAE, which is not mentioned clearly in the corporate tax, but indirectly in various other regulations or requirements of the corporate tax law. They also mentioned that the company should be effectively being managed and controlled from UAE, from free zone, if they need to get this status. So in overall summary, what is I'm trying to tell you is that the substance test, more or less, it is same under corporate tax as well as under economic substance regulation. There could be some differences in terms of the activities that they expect to conduct, but the expectation in overall, it is one and same. Now going back to the corporate tax requirement of qualifying reason person. So Manish mentioned that qualifying income attracts 0% corporate tax, Non-qualifying income attracts 9% corporate tax. Now let's look at what is qualifying income and what is non-qualifying income. Qualifying income, they have given the definition. Any income that is generated from another free zone person, and those activities that the free zone company conducting is not from excluded activities. So you can have a business in a free zone and your clients are in free zone, and your business activity is not one of the excluded activities mentioned. We'll look at the excluded activities list, but yeah, this is what is the expectation of qualifying income. The second expectation is that you could have income from a qualifying activity. They have given the list of qualifying activities, and your clients can be of anyone. So you could be doing business with companies in free zone, companies in mainland, or companies outside UAE. But your business should be one of the activities mentioned in the qualifying activities list. So this is the second definition of qualifying income or item of qualifying income. The third income or third item is that any other income other than the above two, but that income is not significant, that is very minimal compared to your total overall business or total business. So what is that minimal? They are given that your other income other than the above should be less than de minimis. What is de minimis? De minimis is the lower of your qualifying revenue that does not exceed 5% of total revenue, or 5 million dirhams, whichever is lower. So lower of your 5% of your total revenue or 5 million dirhams. That is what is a de minimis threshold. So your other income should be less than this de minimis threshold, then that also will be considered as qualifying income. So as long as you have this qualifying income, subject to meeting the other conditions of qualifying free zone person, your income will be subject to tax of 0%. So that is the definition of qualifying income. What is non-qualifying income? So a non-qualifying income, as I mentioned, it is subject to tax at 9% straight without giving any basic exemption of 375,000 dirhams. Even if you have 100,000 dirhams or 100 dirhams as your profit coming from non-qualifying activities and non-qualifying income, then that 100 dirhams will be subject to tax at 9% straight. So what are those non-qualifying incomes? Non-qualifying incomes are revenue from immovable properties which are located in free zone, and that property is a commercial property and you are letting it out to a non-free zone person. So a commercial property located in free zone is letting it out, or you are selling it to a non-free zone person, then that is considered as non-qualifying income. Not only that, immovable property income which is in free zone and you are doing transaction with any person, but that property is a non-commercial property, then that income also is non-qualifying income. The third thing is that revenue from domestic permanent establishment and foreign permanent establishments, that is also subject to tax at 9% straight. So the definition of domestic permanent establishment or foreign permanent establishment is little bigger. I'm not getting into it, but just to give you an example, you being a free zone company, you have a branch in mainland and you are conducting activities from that branch also in mainland. So that branch potentially could be considered as domestic permanent establishment. Whatever income you generate out of that particular branch activities will be considered as non-qualifying income, and that will be subject to tax at 9% straight. And if you meet the other conditions of qualifying free zone person for your business that has been conducted in free zone, then that will be considered for 0% tax if, as I mentioned, if you meet other conditions. So let us quickly look at the activities which are called as qualifying activities. This is a kind of green list of activities. If you are conducting these activities, you could be getting the benefit of 0% tax, you being a free zone person or free zone company. So quickly to look at, for the purpose of goods, manufacturing of goods or materials, processing of goods or materials within the free zone, then those activities are considered as qualifying income, qualifying activities. Income generated out of those activities will be called as qualifying income. Then it could be getting the benefit of 0% tax. The important thing to look at here, the third point, is distribution of imported goods or materials in or from a designated zone to a reseller. Since you're talking more about distribution, retail and trading activities, so this point is more relevant for us. So this, if you look at this sentence clearly, it is very narrow definition or narrow activities item. So they clearly mention the distribution of imported goods or materials, which could be either be placed physically in or be traded from a designated zone to a reseller. So you should be a free zone company established in designated zone. You should have those goods physically being located in the designated zone at the time of sale, or they are imported from outside to that designated zone and then passed on to the seller, and that seller should be a reseller. So he should not be consuming or using those goods internally for their consumption. So they should be a trader. So you are selling it to a trader, so it should not be to an end user. So subject to meeting these conditions, so your trading activity could be considered as qualifying activity. With respect to services, they have mentioned other activities like holding of shares and other securities, ownership, management and operation of ships, reinsurance services, fund management services, wealth and investment management services, headquarter services to related parties, treasury and financing services to related parties, financing and leasing of aircrafts including engines and rotable components, logistic services, ancillary services to the above list of activities. All these could be considered as qualifying activities. Any income generated out of this could fall under qualifying income and then be subject to tax at 0% tax if you meet other conditions of qualifying free zone person. Let us also look at excluded activities. So this is a kind of gray list of activities. If you conduct any of these activities, you may not get the benefit or status of this qualifying free zone person, and then you must be subject to tax at regular rates like 0% or 9% accordingly. So transactions with natural person other than ownership or management of ships or fund management services, wealth and investment management services, and financing and leasing of aircraft. So any other businesses you do with natural person, you being a free zone person, your activity will be considered as excluded activity, and then you will be subject to tax at 0% or 9% activity accordingly. Banking activities, all the banks in free zone will be subject to tax at regular rates. Insurance activity other than reinsurance, financing and leasing activities other than financing to related parties, and financing related to aircrafts. Ownership or exploitation of immovable property except the transaction with another free zone person related to immovable commercial property in free zone. So this is also going to be excluded activity. Exploitation of intellectual property assets income. Any income that is generated by exploiting the intellectual property like trademarks, softwares, any other similar assets, if you are able to get a generate income out of it, that could be considered as excluded activity income or non-qualifying income. Any other ancillary activity listed above will also be considered as excluded activity. So if you conduct these activities, you will not be able to get the status of qualifying free zone person, and then you will be subject to tax at regular rates, though you are a free zone company. So this is about free zones. Now let's quickly look at the definitions given. These are the definitions which we have taken from public consultation document, which was released by Ministry of Finance recently with respect to free zones. We have taken these examples because we are talking about distribution activity more. So let's say you are a distributor located in designated zone. So they clearly mentioned that the designated free zone person buys goods from country A and sells these goods to retailer in UAE. So distribution company earns a profit or margin on the goods sold to the retailer. The goods are shipped by the manufacturer in country A to distributor company in the designated zone from where they are importing into UAE. So you are a free zone company in designated free zone. Actually, you are a distributor. You are buying goods from manufacturer in country A, bringing them to designated zone, and then you are supplying them to a retailer or distributor in mainland, right? So goods are physically coming from outside to designated zone, and then they are moving to mainland company, and you're selling these goods to a distributor or retailer. Then your activity will be considered as a qualifying activity. whatever your income you generate will be a qualifying income, and then you may be subject to tax at 0%, subject to meeting the other conditions as we discussed earlier. So this is one example which is clear, which is also in line with the expectation of the law that we have went through in the qualifying activities list. Now interesting example comes to this, like they have given this example only in public consultation document. Public consultation document is a document released by Ministry of Finance just to get the opinion of the public. This is not part of the law yet, and this should not be considered as law. We need to wait for either further clarification or an amendment to the law to see if this particular incident of this particular arrangement will get the benefit of 0% tax or not. But since it is mentioned in the public consultation document, so I've just taken up this example. This covers your high sea sale or third port shipment. Let's just quickly go through the example. Distribution of goods or materials outside of UAE. Designated free zone person, which is a distributor company, buys goods from manufacturer in country A and sells these goods to a retailer in country B. Distributor company earns profit or margin on the goods sold to the retailer in country B. The goods are shipped directly from the manufacturer in country A to retailer in country B. So this is clear third port shipment. You are buying from a manufacturer in country A, directly shipping that to a retailer in country B. You being a company in UAE designated free zone, right? So though the goods are not physically moving through UAE designated free zone, they are directly moving from country A to country B. This transaction is also considered as something falling in qualifying activities under PCB, which is public consultation document. So let's wait and see if this will be incorporated in the law by way of amendment, or are they going to come up with any clarification to give us more clarity on this. I'm sure most of the companies in the free zones or in the mainland also have, at least especially companies which are into trading, have these kind of arrangements. So it will be interesting to see how FTA or Ministry of Finance will look into it and then finalize on this. As of now, this particular transaction is not part of the law if you go with the strict interpretation, a clear interpretation of what is mentioned in the law in English version of it. Okay, so let's wait and see what is the clarity going to be on this. So let's look at the VAT impact on designated zones, how VAT is applicable for the companies in designated zones. So just to give an understanding of the designated zones, in VAT law, they mentioned that they only given the definition and the list of designated zone, and they did not mention or refer to other free zones. So designated zones are those free zones which have custom bounded area and the goods moving in or out are monitored by the customs authority in that particular free zone. And that particular free zone follows the rules mentioned for the free zones. If they meet these conditions and if that particular free zone is mentioned as designated zone in the VAT law, then only that free zone will be considered as a designated zone. And for VAT purpose, the free zones are only designated zones. Rest of the free zones are considered as if they are mainland for VAT purposes. Let's see various scenarios. Let's say a designated zone company is doing a transaction to a mainland company. So the designated zone company is selling goods to a company in mainland. So what is going to be the tax in the hands of our designated zone? When I say tax, it is VAT, value added tax. So 5% tax will be applicable in the hands of the importer, whoever is going to take clearance of those goods from customs to mainland. So the designated zone company is using their customs number or their TRN number to clear the goods from designated zone to mainland. Then the designated zone company becomes importer and they'll be subject to tax of 5%. Of course, they'll have to take it as import, and then reverse charge mechanism is what is going to be applicable for that particular transaction. On the other hand, instead of the designated free zone company or designated zone company, if the clearance of the goods from free zone to mainland is done by the mainland company, the buyer, then the buyer becomes importer on the document and he will be expected to comply with this VAT requirement. And for designated zone, this becomes out of scope transaction. Let's look at another scenario, whereas the mainland company is selling goods to a designated zone company. It is straightforward case that the mainland company in US, they are subject to, or they are expected to charge 5% VAT on their goods, subject to looking at the other conditions of zero rated supplies or exempted supplies. They have to charge 5% VAT or 0% VAT or whatever the case may be, and designated zone company will have to pay the VAT amount to the mainland company. And another scenario where the designated zone company is supplying these goods to outside UAE. So the company is in designated zone, the goods are also physically in designated zone, and they are supplying these goods to outside UAE. Then that supply becomes out of scope from value added tax point of view. So this is how the rules are different from corporate tax with respect to designated zones and value added tax. Let us just look at more instances with respect to the transactions that take place within designated zone from value added tax point of view. This is a small chart that is available for you to easily make out whether it will be subject to tax, whether the transactions place of supply is going to be in UAE or out of UAE. So this is a chart that explains that. So is your supply a goods or services? Let's say that it is a goods. If that is a good that you're dealing with, so are your goods purchased by the recipient to be used by it or another party? So are you going to consume those goods in designated zone after buying? Means you are supplying goods from designated zone company to a designated zone company. Are you going to consume them? Are you going to trade that further and resell it? So if you are not consuming, then that becomes out of scope. But if you are consuming internally, then the question will be like, the buyer who is going to consume those goods after consumption, will that be in different form or shape be again sold to someone else? Or will that be used as an equipment to purchase some goods and those goods are supplied to someone else? Then also that transaction becomes out of scope. So the bottom line is that if any goods that are being purchased in designated zone, if they are going to be consumed in designated zone, then that becomes a taxable supply. Other than that, if it is going to be retraded or resold to someone else or used for a production of a product which is going to be supplied, then that particular transaction is going to be out of scope. All right. And the other general thumb rule is that any services that you perform within designated zone or mainland, that will be subject to tax in general. Either it could be at 0% or 5% as the case may be. So let's quickly look at the connected persons and related party transactions. So who is related party? Related party is a owner of a company who owns 50% or more shareholding of a company. Then this owner becomes the related party to that company. Or there is company A which is investing in company B, and the ownership is more than 50% of the share capital of company B. Ownership and control rather, if that is 50% or more of company B, then this company A and company B becomes related parties. Not only that, company A is investing in company B is investing in company C, and all these investments are more than 50% of the investee company share capital, then all these companies A, B, C together become related parties. So that is the definition of related parties. There's another definition called connected persons, wherein the owner of a company becomes connected persons to the company. Not only that, the directors, the officers who are at key managerial position of the company also become related parties. In addition to that, the owner, director and the officer plus their relatives, all of them become related parties to the company. So what is the importance of these related parties? to be understanding, like, what do we have to look at this? What is the importance of it? So any transaction that company does with these related parties or connected persons, the company should make sure that those transactions are dealt with at arm's length. They have to comply with the requirement of the transfer pricing guidelines. So these are the various kind of transactions that you may see happening or taking place among related parties, between related parties, or with connected persons. Like, you may be providing for a group company, like, IT services or IT services or marketing services. A company in a group may be taking care of the IT requirements of all the group companies, okay, and that service becomes related party transaction. A company in the group may be buying goods from another company in the same group. When I say group, it is tax group for corporate tax purpose. So this arrangement or whatever we are talking is under corporate tax. So you may be buying goods from a related party. You may be using the tangible or intangible properties of another free zone person, another group company, or you may be arranging financing. So a holding company may be arranging financing to the subsidiary companies of the group in the group, or you may be arranging capital. You may provide services internally within the group, or you may have domestic transactions, like, a group company being in a free zone may be providing some services to company in mainland, and these transactions become transactions with related parties. Transactions with connected persons, as I mentioned, connected persons are the owners, directors, and officers plus their related relatives. All of them become connected persons to the company. So any transaction that company does with this connected persons should be at market rate. They should be at arm's length. The common transactions could be like, the company may be paying salaries to the directors or owners or officers. Company may be paying rent if the property of the owner is rented out to the company. Company may be paying interest to the owner if they are funding or giving finance to the company. So this similar kind of transactions, those transactions are considered as transactions with connected persons. Those transactions should be at market rate. They should be at arm's length. So you have to make sure that the transactions with related parties, transactions with connected persons should be complying with the requirements of the transfer pricing. So now we are going to discuss more about the expenses that are allowed to be deducted or not allowed to be deducted under corporate tax, for which I would invite Manish to take it over. Manish, over to you.
So the qualifying free zone activities and then the related party transactions. But now we will look at what are those expenditures which are allowed or disallowed, under what conditions you can claim that to derive your taxable income. So the first criteria to claim your expenditure is that it has to be with respect to your taxable year. So as we have seen, the taxable period starts for a financial period January to December will be 1st January 2024. So any expenditure incurred from 1st January 2024 will be eligible to be claimed as a deductible expenditure. So expenditure which are pertaining to 2023, even you are paying it in 2024, January or February, you cannot claim that expenditure in 2024. And then it has to be wholly and exclusively for the business. So there could be certain expenditures which are being incurred, like for your traveling expenditures or your fuel expenditures, which could be partly for your personal, partly for your business expenditure. So that we'll have to allocate that portion of expenditure, which are for the business and which are for your personal purpose. So only official business purpose can be claimed. The second point is not in capital nature. That means if you are buying a car or basically or printer, which are capital in nature, so those expenditure cannot be deductible. Like if you're buying a printer for 5,000 or 6,000 or a car for a value of 80,000, you cannot deduct that expenditure in the same year. But instead, you will be eligible to claim as a depreciation of that useful life of that asset over the period of the life of that asset can be claimed as an expenditure. And then it should not be an exempt income. The expenditure should not be pertaining to an exempt income. The exempt income could be in the form of dividend or profit being received from the investments. So any interest paid on borrowing that fund to invest in the other company, so the dividend which is received is an exempt income. So the expenditure of interest expenditure incurred will not be deductible. And then any other expenditure which the government would time to time notify would not be deductible or deductible expenditures. Now, what are those non-deductible expenditures specifically mentioned is donations or grants. Any donations or grants are not eligible to be deducted, but if it is with respect to the qualifying public benefit entities, which are non-profit organizations, and ministry has listed down certain 120 plus qualifying public benefit entities, if you donate or grant on those business on those public entities, then you can claim as a deduction. But if those are not being part of those list of entities, then the deductions cannot be claimed. Now, another important point is with respect to the input VAT, which is claimable, and if you are not able to claim it, for example, like your telephone bills, where the amount of input VAT is very minimal, or your fuel bills very minimal, where we are not keeping a track of those input amount. So if we don't claim that input amount from your output VAT, then we cannot claim it under the deductible expenditure. And then similarly, your bribe, solicit, like these are not a genuine business purpose, it cannot be claimed as a deduction. Another key point is with respect to the entertainment expenditure. So entertainment expenditure, which is incurred for your customers, your business partners, your shareholders, suppliers, like in terms of meals or transportation or any kind of entry fees, those expenditures can be claimed, but there's a limitation. It can be claimed up to 50%. But now, if similar expenditure, like companies organizing meals or any, get together for their employees, then those expenditures can be claimed. For employees, 100% can be claimed, but with respect to the entertainment expenditure for your customers, shareholders, suppliers, business partners, it's limited to 50%. Then with respect to the fines and penalties, like you have RTA fines, which are or a delay penalty for a VAT filing return, those cannot be claimed because those are not a commercial business purpose. It is because of the default you have made, so that cannot be claimed. And any dividend and profit distribution, because dividend and profit are basically paid after the tax. These are not an expenditure. So it's a portion of profit being distributed. So it's not a deductible expenditure. And then with respect to the net interest expenditure, so interest paid on the bank borrowing or funding, that is also limited. Now that limitation is up to 30% or 12 million. So the limit is very high in terms of 12 million, depending upon the business size. So now EBITDA, it's limited to 30% of EBITDA. That means earning before interest, tax, depreciation, and amortization. So if a company has a EBITDA of 1 million, then the limit of interest is 300,000. But since the limit of 300,000 is less than 12 million, 12 million is higher. So if an interest expenditure is like 400,000, they can claim the full 400,000. It will not be limited to 300,000 because the maximum limit is 12 million. And any kind of tax being paid, which could be in foreign tax or even a corporate tax, these are not a deductible expenditure. And then another point is with respect to the funding by the owners. They're giving a fund, short-term funding to the businesses, and that business purpose has to be genuine. Like if it is for the working capital funding, then it is allowed. But then the arm's length principle of interest will be considered. But if that is not for the business purpose, but that is for withdrawing the profit from the company, then that funding will not be allowed as a deductible expenditure. The interest paid on that will not be allowed. This is what we looked into entertainment expenditure. Then there is a concept on the small business relief. This small business relief is applicable to the only resident taxable person, and then the revenue is up to 3 million or less than 3 million. And that revenue has to be computed as per the accounting standard, which is generally IFRS. And this relief is available for the period up till 31st December 26. So this is temporary relief. And what does the relief allow? The relief, those who are going to be eligible or apply for the small business relief, then they will not be paying the corporate tax. And that has to be declared in the first income tax return filing. And also, if they claim to be getting the relief, business relief of small business relief, then they cannot carry forward the tax losses, or the interest portion cannot be carried forward. So there are certain limitations. If they are going to claim this benefit of small business relief, they cannot carry forward any losses during this period of small business relief. But if there's something which is during which they have not been part of small business relief, those previous period can be carried forward. So suppose if you have not claimed in 24, if you want to claim a small business relief in 25, then your in 2024, whatever your losses could be, it can be carried forward. Then the other concept is regarding the tax grouping and the qualifying grouping. So for the corporate tax purpose and the VAT purpose, there is a difference in which there is a difference of way in which they can form a tax grouping. So under the corporate tax, if you look at it, it is the requirement is that you need to be a judicial resident person. That means an LLC companies or any kind of judicial persons could be forming a tax grouping. And similarly is also the provision in the VAT law also, it is a legal person, not a natural person or individual who can form the tax grouping. Then under the corporate tax, it is the 95% shareholding has to be there, the voting right has to be there, or the controlling has to be there to form. Like, company A is holding on company B 99% or more, or 95% or more, then it can form. And it could be direct and indirect as well. Whereas in the VAT law, it is 50%. So if even like, up to 50%, they can form a tax grouping, whereas in corporate tax, it is 95%. Then if the parent and subsidiaries are exempt, if either of the parent or subsidiaries are exempt, that means that there's a parent company, there's a company A holding an investment in company B in the free zone, which is a qualifying free zone. So parent company in the mainland A cannot form a tax grouping with the subsidiary company B in a qualifying free zone, because the qualifying free zone, the tax rate is 0%, and whereas the mainland company A is paying 9%, so they cannot be forming that grouping. And then another criteria is that they need to have the same financial period. So generally, because it is required to consolidate the financials of the parent and the subsidiaries company, so they need to have the same financial period. And then the same accounting standards should be followed, which is basically an IFRS for the comparison of the financials and the consolidation. And the other point which is different in the VAT, it is clearly mentioned that they need to have a business. Yes, that is common. Corporate tax also will be only eligible when they're carrying on the business. But the other point is regarding the fixed establishment in UAE, and it could be any kind of, even the foreign branches could form tax grouping in under the VAT. Whereas under the corporate tax, a foreign branches is only the residential judicial person can form. So a foreign branch entity is not a resident person, then it cannot be forming it. And then there's a threshold limit of registration, which is 375,000. If the entity individually or within the group is meeting the VAT threshold limit of taxability, then they can be forming the group. Now, what is the impact of having the tax group under the corporate tax? Is that they are a single person, and then the parent company need to comply with the registration and the filing and the payment, and then they need to prepare the consolidated financial statement. Then any kind of intercompany transactions, intergroup transactions will be eliminated when they're consolidating it. And in terms of tax liability, the parent and subsidiaries shall be jointly and severally liable. So each of those individually also, they need to pay for that portion. So the payment will be done by the parent company. And then the tax grouping shall cease to exist when it is not meeting this criteria of 95% and the common shareholding and the interest. And the parent company can be replaced, like parent company P can be replaced by another parent company H who's taking over that business. And in the VAT, the effect of the tax grouping is that there is again a single tax registration number, which is similar to what it is in the corporate tax. And then the supplies made within the VAT group company. So within the VAT group company, if a supply is being made, then there is no VAT transaction. VAT will be applied. It will be removed from that. The VAT will not be applied. It is similar to the corporate tax also, where the intercompany transactions will be eliminated. And then the tax group limits only submits one return annually, quarterly, based on the turnovers. and then one member of the tax group will be representing the whole group. So there would be A, B, C, D are the group, and only one member, that is A, can apply to represent the others. And then similarly to the corporate tax, they are jointly and severally liable for that VAT liability. So, and then there's a concept of qualifying group. So if they're not able to meet the tax grouping criteria of 95% and the corporate tax, they can still be a qualifying group where they benefit of transfer of their losses within the group company. And then for that, which is 75%, it could be direct or indirect. Of course, it is again the judicial resident person. And then exempt or a qualifying free zone person cannot form a group because the tax rate are different for mainland or a qualifying free zone, which is 0%. And then they need to have the same financial period, and then accounting standard, which is IFRS, should be followed across other group companies. Now, the other provisions with respect to what is the impact of VAT in the retail and the distribution business, there are certain transactions I'm going to highlight. It is with respect to high sea sale, similar to what Balram was mentioning of a goods movement from from one country A to country B directly without touching the port of UAE. So it is out of the scope for the VAT purpose. The tax is not applicable. Like India to China directly, the VAT will not be applicable for that. And then for export and re-export business, a goods exported from UAE, of course, it is a zero rated. But re-export means the goods has landed to the designated zone and then being exported from India, it is landed to designated zone and being exported to re-exported to Oman. Then that again the VAT will not be applicable, But then of course they need to have proper custom record document. Then a consignment sale. Now in the under the VAT, there are two category of agents being classified as disclosed agent and undisclosed agent. So a disclosed agent is basically a authorized dealer or distributor for a particular brand like HP. There is an authorized distributor or dealer for that specific brand. Then it is a direct agent or is a dependent agent of the HP. And undisclosed agent is like he's doing a dealing, an agent who is doing dealing for different other brands. Then it is an independent. So the VAT will be, so in disclosed agent, the responsibility of the VAT is the supplier, the HP, and whereas in undisclosed agent, being an independent, selling different other products like Sony, HP, and other electronic products, then the responsibility will be of the agent for the VAT. Now, in case of any sales return or credit note happening, like if there is a sale which has happened in the month of July, and then that is the return is happening in the September month, then the whatever VAT we would have paid, then that can be adjusted in the month when the return is happening and when the credit note is being issued to the customer. And then in case of bad debt, for if the sale has happened and we have recognized the VAT for that output VAT, and we haven't received the money for those outstanding receivables, and then the receivables outstanding should have been outstanding for more than 6 months from the date of supply. So if we have made a supply in the month of January and until September we have not received that money from them, then we can make an adjustment for the bad debt, but we have to write it off in our books, and then we have to also communicate to the customer that we have written off that debt. Then only the VAT portion for that can be adjusted in the return. Now, with respect to the economic substance regulation, the impact for the distribution and the service center, which is like a trading activities. For the distribution and service center, the applicability is like if a company which is set up in UAE is buying and selling, is basically procuring that goods from this foreign connected party. That means a company A in India, which is supplying to a subsidiary company B in UAE, then that purchase is happening within the foreign connected person, and those are being distributed in UAE by the company B. Then thus ESR is applicable to it. And then the certain core income generated activities which are defined under the distribution business is transportation and storing of goods. So the warehousing is there, managing the inventory or order fulfillment, through the basically booking the order, taking the order on behalf of his subsidiary, his parent company in India, in UAE. So there is a relationship of parent and subsidiary or a related connected party relationship in UAE from his Indian entity. Then the ESR is applicable to it. And with respect to the service center business, so if they are providing consulting administrative services to his foreign connected person, that means a company in UAE is providing services to a company in Saudi, and that company is a foreign connected person. That means the company has a common shareholding or common interest. So company B, which is based out of Dubai, providing services of like IT services or account services, support services from UAE to Saudi, then the ESR is applicable to them. Now, when the ESR is applicable to them, what is the requirement? Then they need to file within 6 months of the financial period the notification. So now, if some company has a financial period from April to March, March 20th. So March is the year ending. Then 6 months thereafter is September. So if someone is closing has a March 23 is a closing for them, then the ESR requirement notification is until September 30th, September 2023. They need to notify to the ESR authorities, which covers basically their nature of relevant activities being carried out, the relevant income being, what is the relevant income being generated, and what is the financial period, and other information which is required. And then there is also annual reporting we need to be submitted after the end of their financial period. So 12 months, that means if their financial period is ending March 23, so then they need to file the annual report by March 24, 2024, which basically talks about having the economic substance test requirement, assessing that which Balram mentioned about the criteria for substance test under the ESR need to be fulfilled, and then certain other reporting which has to be declared in that. Now, in terms of accounting record keeping, which has to be required in the corporate tax and other different other provisions are, now the first we talk about the time period for which the record keeping has to be maintained. Under the corporate tax, it is required to be maintained for 8 years, 8 years inclusive of the current financial year. So the corporate tax is getting effective for the period of January to December, that is from 1st January 24 for those companies. They have to maintain those records for 8 years inclusive 2024, that is until 2032. And then for VAT purpose, the record keeping period is 5 years, and for ESR purpose it is 6 years. And then there is an audit requirement also as per the corporate tax, that if the company is having their annual turnover more than 50 million, then they need to have the accounts audited. And also for those who are meeting those criteria of qualifying free zone, claiming that benefit of qualifying free zone, they also need to get their financial audited. And then beside any other records, the authority can ask for or ask to get audited. And there are several penalties, penal provisions under the corporate tax, under the VAT and the ESR. Now, in terms of what are those records keeping to be maintained, of course, it is the financial which they need to maintain. That is the balance sheet, profit and loss, the salaries, the payment to the employees, their fixed assets, purchases happening, the fixed assets physically present, the inventory records, the movement of the stock quantities, and any other businesses activities. Ultimately, they need to compute their income. So when they're computing the income, all kind of expenditures being incurred, all kind of financial activities taking in the businesses need to be recorded properly. And in terms of the documents which are required to support the book entry is with respect to it is for the contracts to be maintained, the invoices to be maintained, and then any kind of transactions between the related parties need to be documented. And then with respect to any kind of applications or the determinations which you have considered for calculating your tax, that need to be documented, the basis of accounting method being used, and records of course a fixed asset. And whatever supporting document which has been mentioned in the corporate tax similarly also applies in the VAT as well. So in the VAT as well, they have mentioned about their tax invoices, the calculation being done, the working being done for arriving at the taxable VAT, and the related party transactions and the transfer pricing documentation to be done, maintained. And now, in terms of city administration, I would request Balram to take over this on the balance. What are the administration requirement for the corporate tax?
Thank you, Manish. Yeah, so just to look at the last part of the session, the we know that clearly that they require every company to be registered under corporate tax. So who all are required to be registered? So every company that is registered in the company in UAE, they are expected to register unless they are exclusively or specifically exempted from registration from compliance of corporate tax. And then registration can be done online, and there is no minimum threshold. Every company, without having any minimum threshold of revenue turnover, everyone should be registered. Whereas in the case of VAT, unless you have 187,500 dirhams as the taxable supplies or taxable expenses, you're not eligible to go for VAT registration and apply for registration. Whereas in the case of corporate tax, it is not like that. Every company should be registering them. The registration forms are already available on the Imara tax. As of now, officially FTA opened the registration forms only for LLC companies and public joint stock companies. The other companies other than these, though you may see the form available to register, but the applications are not being approved by the FTA in most of the cases. Now let's see what are the returns requirement. So for corporate tax purpose, you need to file one corporate tax return at the end of the year for the whole year. And that has to be filed within 9 months from the end of the financial year. Not only filing, you also need to make the payment within that 9 months period after the end of the financial year. These returns to be filed will be filed on electronic mode, like we have in for VAT purpose. It will be MRR tax that will be used, and then there will be a separate form for corporate tax returns to be filed. Just before that, I just thinking of the if a company is running a distribution activity, and that could also be falling under economic substance regulation, what are the total government returns or forms to be submitted in a year? So just I was trying to understand. So the list is like increasing day by day. If you see currently we have value-added tax returns to be filed quarterly. Now going forward, corporate tax returns will be filed on a yearly basis. Since the company is also conducting the distribution activity under economic substance regulation, they have to file economic substance regulation ESR notification after 6 months from the financial year. They have to file economic substance regulation report after within 12 months from the end of the financial year. They have to submit audit report if that they are part of a free zone. They need to submit a disclosure form if they are making transactions with a related party along with the corporate tax return. If the company is having turnover of 200 million dirhams or more, then they have to maintain master file, local file, and they are part of a larger multinational entity. They have to also maintain or submit country by country reporting. So these are the various kind of returns or reports that you will be submitting throughout the year. So it's almost important to have track of those dates, deadlines, and information that is required to file or to meet those requirements. So it's very important to maintain the books of accounts properly, as well as to comply with these requirements in time to avoid penalties. Not only this, if some company is falling under anti-money laundering law requirement, they have to again register themselves, maintain the policy, make sure the training is given to the employees, customer due diligence is being conducted properly, all those. So this is a template of the corporate tax return that we prepared based on the information available in the law. You will take accounting profit as basis, and to that you will make adjustments of deductible and non-deductible expenses as well as income. You arrive to taxable income, then you calculate the tax on the taxable income. Then that will be adjusted against withholding tax or foreign tax credit or any other relief in terms of tax loss relief or other reliefs. Then you will be ending up with net tax payable to be paid to the government. These are the key areas from corporate tax point of view to look at it. Like you have to review your corporate structure to get the optimum taxation or tax benefit, or to have optimum tax situation or status. You also need to look at whether you're a Frisian company or mainland company. Do you have business which has got opportunity to have them in free zone to get the corporate tax 0% tax benefit? You have to review your structure to see whether you can form a tax group, or do you want to have a continue as a standalone entity to get the benefit of taxation on individual entities. You have to look at all those things. In addition to them, you also need to look at if you have any transactions with related parties or connected persons. Do you have them at arm's length, market price or not? Do you need to make any adjustments to your books of accounts to bring that into at market rate? You also need to identify your income streams and see whether you have any exempted income which may not be subject to tax, and then account them separately. You also need to see the impact of the corporate tax on your cash flows and your profits and your debt equity structures. You have to look at your chart of accounts and see or make sure that you are ready to comply with the requirement of corporate tax returns to be filed. Do you need to look at your systems to change to be able to handle the requirements of corporate tax law? And also review the possibility of deductible and non-deductible expenses. If you have any non-deductible expenses, do you have to account that separately under separate ledger or account to be able to easily prepare your corporate tax returns at the end of the year? If you have any non-resident entities, you need to look at the PE being here or not being here in UAE. Do you have entities which are outside UAE but they are effectively being managed from UAE? Then that becomes subject to tax in UAE, though the company is outside UAE. You need to make sure that you are looking at that and then making sure whether you want to or not want to be considered as taxable person in UAE, though it is a company outside UAE. So all those things you need to look at it. Make sure that your contracts are reviewed properly to be in line with the requirements of the corporate tax law, and make sure that you have enough training, assessment, impact assessment on your books of accounts. So we do conduct impact assessments. We do suggest or come up with the planning for corporate tax to get the optimum taxation benefit or status. We have an expertise team on corporate tax as well as transfer pricing. We do benchmarking and then we provide transfer pricing services also. In addition to that, as I mentioned earlier, we do audit, accounting, taxation, plus internal audits and risk management services. Plus we do company formations and PR services. So this is what we wanted to cover as part of our session today. These are our contact details if you want, if you have any other questions to be answered. I see there are some questions in the chat box. We will be addressing them also. So yeah, this is what we wanted to cover as part of our session. But yeah, now we are open for question and answers if you have any. Meanwhile, if you have to address the questions that were already asked in the chat box, let me read them once. I think if a company has no assets or employees, then it will not be qualifying prison company, right? That was the question. As I mentioned, see, this is what is required from the point of view of free zones to get the eligibility of qualifying prison person. One of the important condition to meet is to have adequate substance. So having adequate substance means you have to look at your business size. You also need to look at your nature of the business. So to your size of business and to the nature of business, do you require to have employees? And how many number of employees do you need to have? If your company is investing into one or two real estate properties, then you as a owner may be sufficient to manage that particular property. Then you may not require to have employees. In which case you may be still considered as having adequate substance in UAE. Whereas I mentioned you have a business of 100 million turnover into trading. Of course, you need to have enough number of employees and other requirements. So it all depends upon your business size as well as nature of your business to see whether you have adequate number of employees, asset base, operating expenses, the management is sitting here in UAE and running the business or not. That is what is the answer for that question. Manish, do you want to address the second question? Like, If two companies are sharing the expenses and it's hard to determine, for example, tools used in each project of both companies, how to deal with this?
So if two companies are just, if I get the question, like, if two companies are sharing the expenses and because I cannot see the right chat up, can just repeat again.
Yeah, I'll repeat it. If two companies are sharing expenses and it's hard to determine, for example, tools used in each project of both the companies. So they are using some tools commonly for company A and company B, and these two companies, I believe, are separate taxable persons. Then how do you allocate the expenses relating to these two tools to those two companies?
I think it is very business specific case scenarios which has been raised, and it has to be identified with respect to, I mean, there could be common tool being used in two different entities, legal entities for the business. I think that would be based on the maybe it could be based on the hours that being used, or it could be based on the nature of activity being conducted by that particular tool. So there has to be some basis allocation internally they have to work out, and that working has to be well documented, and based on that, the cost being assigned to it could be appropriated with that project within that particular project.
Great. There's one more question also. How to classify an investor who invested in the company and owns 50% of the shares, but inactive, meaning he is only mere investor in shares, thus all his other companies will be our company's related parties or not. Consider who don't have any transactions with them. See, in terms of definition, yes, if you have a common owner and that owner is investing into your share capital and other company's share capital with 30% or more ownership or control, then these two companies become related parties in terms of definition. But if you don't have any any transactions with that other company, then there's nothing to do. The only issue will come if you have transactions with that another company which is a related party to you, and then you need to make sure that the transaction that you do with that particular company, is it at arm's length or not? Is it at market rate or not? Is what you have to look at. So it becomes challenging in some cases. You may or may not be aware that the owner is invested or having investment in other company, which could become a related party. So far, it was all right not to look at that, but now you have to make a list of all those companies which are being invested by your owner. You have to make sure that do they fall under related party definition or not, and then comply with the other requirements of the law. Is there any certificate of attendance for attending this session? Sorry, we are not conducting a training as such. It is just awareness session, so we do not issue any certificate. But as mentioned by Manish, we will be sharing the presentation for your reference. But finally, you have to look at the law released by the ministry to take any decision. So this is not an official session. This is only our personal opinions that we have shared, and this should no mean be considered as an official clarification or opinion. There is one more question. What is the treatment of retention receivable in corporate tax if these will not be collected within the year? So in most of the contracting businesses, so you have retention money. See, for corporate tax purpose, you have to follow and maintain your books of accounts under IFRS, International Financial Reporting Standards. So what do you do with this retention money under IFRS is what you have to look at. Just to give you an idea, it depends upon what kind of retention is it. Is it a retention to make good of any issues that may occur after handover of the project? And is it supposed to be a revenue portion that is to be recognized only after expiry of that period? Meaning that is considered as separate element of your revenue to be recognized only after completion of that particular period, then you will not recognize that as revenue in your books in first place. Accordingly, that will not be subject to tax in the year. It will be subject to tax only in the year in which you recognize that as revenue. There's one more question before we wind up. We operate a marketing research firm. Being a DSO license, we generate more than 200,000 in profit each month. Total 4 employees. Could you please indicate the maximum salary the owner can accept? 100,000 monthly possible. This is again relating to transaction with connected person, payment made as salary to the owner. See, there is no straightforward answer to this question. As I mentioned, it is relative to your business size, nature of the business, the qualification of and experience of the owner, and what is that service that you are actually providing, what is the value addition that you're making to the company, to the business, you as a owner, whatever services you're providing. What is this general parameter generally in the market? How much is it being paid? With these parameters being considered in your region, in the region, in the industry, in your area, that's what we have to look at and make sure that your payment of salary is in line with the industry's expectation or industry's benchmark of your size, of your nature in the region. Plus, whatever profit or net profit that you're offering to the tax authority to compute taxation, is that ratio or profit ratio is in line with industry. These two things need to be looked at and then arrive to what is the right amount to consider as a salary to be paid. Yeah, I
And
think we
I
have
think,
addressed.
well, just to add on to this,
I
we do
I
provide
have
this. Yeah,
Sure.
some.
just to add on to this, no, we do provide this transfer pricing benchmarking for the owner's salary, which can be claimed in their business. So that is specific consultation, which depend upon the actual transaction and the business scenarios, looking into different aspects that require detailed review.
I think
I
Pariksha,
have
you're
some
saying.
questions here. A small business relief is provided to companies having a turnover up to 3 million. So, if a company is having multiple business verticals, can they separate the verticals to get the benefit of the provision? So, if they are having an electronic business, they are trading and they're providing service relating to this electronics. So, can they separate the verticals and separate the revenue? Is this possible to get the benefit of this 3 million small business relief?
Yeah, I'll just clarify on this. Thank you for this question. So under the small business relief, there's a limit of 3 million turnover, which you can be eligible to claim that benefit of not paying a corporate tax. But then there's another concept of artificial separation. So which talks about, you cannot just go and do any kind of, reallocation into your business or restructuring of the business to avoid the tax. So I know that there has to be a commercial business sense when we are actually looking at having a separate entity being created where you want to split the revenue among those entities. But recently there was a detailed guideline being issued on the small business relief where they have clearly mentioned that if you have a common support functions or common shareholding and a common assets and services being utilized within the same group company and the customers are also same, so just to get a benefit of your small business relief, you cannot directly go and bifurcate that into different entities below 3 million each. So each scenarios has to be assessed with a commercial justification, because when you're submitting the return, you have to submit the documents to the authorities and they will assess those criteria. And if you don't fall into that criteria, then there is a like anti-abusive rule, which would fall into where you avoid the tax. You are, making this separation. So generally, it cannot be until there's a commercial business sense to that.
Yeah.
Okay,
Just to
thank
add,
you
I
for
think,
the clarification.
yeah, just to add, see, there could be two scenarios. One company is having two different verticals. Then all those verticals related income will be clubbed as one and then compare with your threshold of 3 million. But of course, with an intention to avoid tax, you are creating multiple companies. You are one company earlier, now you're creating multiple companies just to get into that within the threshold of 3 million dirhams for each company. That is what Manish was trying to clarify, that that is something that is generally not advisable to do. Ministry has clearly mentioned in the small business relief public clarification or guidance that with an intention to reduce the tax or avoid tax, if you do so, then GAR will be applicable to them. All this arrangement of different companies will be kept aside, and then all those companies will be together considered as one. Then you'll be subject to tax based on that.
Thank you for your clarification, sir. I also have another question. As companies with 95% of holding can form a tax group. So in this 95% of the holding by sponsor, which is having 51% of the holding, can also be considered in this to form a tax group.
Okay, thank you again for this question. So now in the under the tax grouping provision for corporate tax, there is a 95% shareholding, but it also talks about the control, the profit sharing. So those element has to be also looked at into it. So whereas, and also it has to be a judicial legal person. When it comes to your sponsors and the local sponsors, they may have in the books the record of 51% shareholding or whatever, but then they might not be having the control or the profit share element in this. So they will not be falling under under the criteria of tax grouping.
Okay, I think we addressed most of the questions. As I mentioned, if you have any other questions or if you want our service to be provided to you, you're always welcome to reach out to us. We can help you in addressing the questions with respect to corporate tax. We can also perform assessment or impact assessment of corporate tax and transfer pricing in addition to other services. We'll be sharing the presentation. We'll be sharing the link to the video of this presentation also. I thank each one of you who have attended this, and we are also planning to conduct more and more sessions which are specific to each industry, which are prominent in UAE, so that they'll be looked at from each other or other compliances point of view also. So for now, thank you everyone for joining us, and goodbye.
Thank you, everyone.